Hey everyone! On the 4th of July, President Trump signed the new tax bill into law. The new tax rules are largely a refresh of the tax policies created in the 2017 Tax Cuts and Jobs Act. Key commercial real estate provisions that will be maintained with no changes include the 1031 tax deferred exchange, carried interest, and the 20% qualified business income deduction, which allows qualifying self-employed people and small businesses to deduct 20% of their business income from their taxes. In addition, the current tax brackets for corporate and personal income remain the same, although they have been increased for inflation. But I'm now going to highlight 7 positive updates for commercial real estate investors in the new tax act. First, the new tax law increases the state and local tax deduction, also known as the SALT deduction, from $10,000 to $40,000 starting in 2025. Under the new rules, the SALT deduction phases out at incomes above $500,000, and this provision will expire in 2030. Second, a provision of the new bill would increase the gift and estate tax exclusion to $15 million for single filers and $30 million for married people filing jointly. Third, the interest expense, which is limited to 30% of the owner's adjusted taxable income plus any business interest income, has been tweaked. The new calculation for the adjusted taxable income no longer includes depreciation, amortization, or depletion deductions, so basically investors will be able to expense more of the interest they pay. Fourth, the low-income housing tax credit program has been expanded. Starting in 2026, the credit allocations will be increased from 9% to 12%, and the new law reduces the private activity bond financing threshold for 4% credit deals from 50% to 25%, and this will basically make it easier to access the tax credits in bond-constrained states, and this will increase the development of affordable housing under the Section 42 Low-Income Housing Tax Credit Program starting next year. Fifth, opportunity zones have been renewed permanently. The new opportunity zone rules will be on rolling 5-year deferral periods with a step-up basis of 10% on the invested capital gains after 5 years. That said, there's a lot of new eligibility requirements, and the census tracts that qualify for inclusion in opportunity zones will be redrawn using a stricter criteria. The new law also creates a new category, the Qualified Rural Opportunity Fund, which offers a rolling 30% step-up basis after 5 years. Now, the new opportunity zone rules go into effect January 1st, 2027, so there will be time to get additional clarity on the many changes to this program. Now, the sixth and probably the most important provision of the new tax law for commercial real estate investors is the permanent renewal of 100% bonus depreciation for qualified property. The bonus depreciation percentage had been phasing out and was going to be 40% this year. But under the new law, taxpayers can claim 100% bonus depreciation for qualified components that have a normal recovery period of 20 years or less. To qualify, the property must be acquired and placed in service after January 19, 2025. Now, a cost segregation study will help investors identify the components of a commercial real estate property that qualify for bonus depreciation. That could potentially include things like appliances, HVAC systems, removable interior partitions in self-storage properties, furniture, and more. The seventh provision is in the same vein. The Section 179 bonus depreciation, the cap on that was increased to $2.5 million. That allows businesses to expense 100% of the cost of qualifying personal property, equipment, and software. So renewing the 100% bonus depreciation will be important to commercial real estate because it helps improve the first-year returns on newly acquired property. That's particularly helpful considering the higher interest rate climate. In many cases, the going-in cap rates on properties have been on par with or even below the interest rates on the debt capital, resulting in negative leverage. Boosting the depreciation of the qualifying components in the first year to 100% could change the calculus and move a property into positive leverage in year one. In addition, the increase of the Section 179 bonus depreciation to $2.5 million means value-add properties could generate stronger returns in their early years of operation as well. So that brings me to one of the most important benefits of passing the new tax law. Finalizing the tax rules will reduce uncertainty. It's hard for investors to make decisions when they don't have clear policy. And by getting this law signed off, investors will be able to integrate the new taxes into their long-term strategies and decisions. And that will help investors keep their eyes on the horizon.